In this week's update, why the US market keeps setting new highs and why Australian investors must make a dramatic recalibration. My name's Gary Davis. I'm an authorised representative of Primary Securities, and the information in this video is of a general nature only. The weeks just keep rolling by and the uncertainty continues. I don't think anything is clearer now than it was when the war started. So it's a tricky environment for investors. No two ways about it, but let's go through and highlight the key points. So if we just step back and just have a look at the big picture of where the market sits at the moment, the S&P index and the Nasdaq has set two new all-time highs during the last week, which, with the straits in the Middle East remaining closed, does seem a little counterintuitive because it's a pretty serious situation with all the consequences that go with that everybody is familiar with. But the reason is, and it's a really good reason, is because US earnings strength and the breadth of that earnings strength is really terrific. It's about the only word I can come up with at the moment. It really is surprisingly terrific. And we've got 178 S&P stocks reported in the last week, 147 beat on earnings. Only 19 of those fell short of expectations. Now, I know that in America it's a bit of a game where the expectations are set with a low bar and the company beats it and everybody cheers and everybody's happy. So acknowledging that, but this is really an extraordinarily high beat rate. And the other part of it is that 139 of those 178 stocks actually had year-on-year earnings per share growth. So that's an outstanding result in any environment and a seriously outstanding result in this particular environment. So if you're scratching your head and thinking that the US stock market has gone completely nuts, then that really is the answer right there. It's earnings strength. And in many cases, the earnings strength is way beyond the current valuation, what the current valuation would dictate. You've heard me say this many times, fundamental logic on its own will not serve you well, yet so much of the recommendation industry for the stock market is built around fundamentals. So it's built around what the stock price should do rather than what the stock price is actually doing. And because the market is a forward pricing mechanism, things will happen in the share price that make no sense at all because that's about the projection of the future. It's not about what the fundamentals are saying right now. So if you are anchored, which is quite natural, but if you are anchored just in fundamental logic, then you're going to be left short time and time again. And if we look at gold, you would think that at the moment gold would be just soaring off the planet given all the uncertainties. But there's actually a number of other things that are going on there, and I'll come back to that. And it's likely that we might be stuck in this kind of limbo land for gold and silver until the market can see a path forward for the war ending, or at least the energy shock part of the environment. And looking ahead, the thing that I'm looking for is where we start to see gold and silver and the gold and silver miners start to outperform the US indices. Because if you look back over the cycles, every time there is a major event, whether it's 2008, whether it's COVID, whether it's a war situation like we've got at the moment, it doesn't really matter. Once we've come through some sort of upheaval in the market, guess what sector almost always starts to rise well before the rest of the indices do, and it's gold and silver in particular. So I'm looking for that. I'm looking for the market to tell me when that time is. And it won't be about the fundamentals. Now, of course, we recommend every week that you obtain all the wider advice that you might need, not just around the stock market, all other investing advice that you may need as well, because this is as tricky an environment as you'll find. And so it's very important to have all of those boxes ticked. Let's look at American stocks now. The S&P added another 1% roughly for the week. The Nasdaq a little bit better, 1.1. And the Russell was up also around about 1%. So pretty consistent breadth there. The US dollar index fell slightly, 98.2. The 10-year yield was 4.38 and the VIX index came in at 17. So the market is not really too fearful. It's moved on. It's focusing much more on earnings. Let's go and look at some charts now. This is the Nasdaq. So this is the fifth week in a row now of successive highs, and you'll notice that whilst the candle ranges of the last 2 weeks have got shorter, they're still closing either on or almost on their high for the week. And that's telling. It means that the buyers are still confident all the way into the end of the week. And so things, unless something changes, of course, some other news headline that comes along, then we should see that buying momentum continue. That's the Nasdaq versus the S&P. So naturally, growth stocks are doing better, and it was a pretty solid week for the Magnificent Seven stocks as well, and that's helping to propel the Nasdaq. Some of the other key spreads, this is gold versus the S&P. So this is the pivot point that I'm looking for with timing back into the gold market. So you can see that in the big picture, and the left-hand side of this chart is the middle of 2024. So it's getting up towards 2 years worth of price action. And you can see the red 200-day moving average is moving strongly and consistently to the upside. And this ratio, which is gold divided by the S&P index, has been rising with it. So that means that gold on the big picture level has been outperforming the S&P, as we all know. But there have been several corrections, and we're in one now. So during this period that started just before the war broke out, we've had gold underperforming the S&P. And because gold tends to move first, then I would expect that a turn up in this ratio is the key pivot point that I'm looking for. So that's one to watch. And this is consumer discretionary versus consumer staples. We had a rebound, cooled off a little bit last week, but nevertheless looking pretty good. This continues, this semiconductors ETF continues to be enormously impressive. And again, there was a bit of selling last week, as you can see, with this long tail, but we finished almost on the highs again, running right into the end of the week with confidence. On a sector basis, the gap between energy and the other parts, particularly technology has absolutely rocketed back from the bottom of the heap over the last quarter and is now back challenging energy. And the way things are set up at the moment, I would expect that when we look at this next week or the week after, that we're going to have technology on the top, because the results from technology companies are by and large really, really strong. And then further down the line, we've got industrials and materials, and then we get to the S&P index itself, and everything else is below that. In Australia, energy is still on top, but look, the Australian market is underperforming, certainly the US and probably many other indices around the world. And you can see healthcare continues to just be an absolute shocker. And it's a mile behind XSO, which is the small caps. XIJ is starting to pick up. So that's the information technology sector. So they're the three that are performing worse than the ASX 200. This is the S&P, again on a weekly chart, so it's very similar to the Nasdaq. XLE also starting to rebound as oil firmed, and then there's the Russell also in new all-time high territory as well. If we look at the currencies, the US dollar index, we had a dip at one stage last week, got down to a low of 97.5, but managed a bit of a rebound on Friday, at least late. The Australian dollar still remained in short to medium term uptrend. And it's hard at this stage to see what's going to really disturb that, particularly when we get a rebound in commodity prices. So turning to the Australian market now, our dollar finished just shy of 72 cents. Our index was down 0.6% for the week and really has a whole lot of problems. Healthcare continues to plummet. It's down 45% since August. And I just want to show you a couple of charts that are really interesting. This gets back to the fundamental logic and using that as your primary tool for evaluating selections in the stock market. This is CSL, one of the market darlings, had done incredibly well over a long, long period of time, but then it broke down quite significantly in August of last year. But the key part about this is, as the price kept falling and falling and falling, there were still recommendations to buy. And the breakdown occurred at 232, and at the end of the week, we finished at 124. So it's down a massive amount, and yet it still keeps getting recommended for good portfolio building. It's just quite unfathomable. And it's not just CSL, this is Cochlear, which also has run into some problems since February. So this is not about the war, this is about the business. And yet it's still getting buy recommendations. It just leaves me quite stunned, to be honest. And that's why, if you're just using fundamental analysis on its own and you're not paying attention to what the buying and selling pressure in the market is, then you're trying to fight this game with both hands tied behind your back. It's just not a smart thing to do. Precious metals, gold fell 2% for the week. We're down to 46.12, but we're still in an overall big picture consolidation. In Aussie dollars, we slipped with the Aussie dollar higher as well, back down to 64, but that's still extremely profitable territory. And our local producers are generating a huge amount of operating cash flow and free cash flow as well. It's just we've got this huge unknown about, obviously, the diesel price and the impact that that has, but potentially also supply availability. And whilst hardly any of the major miners are pointing towards a significant diesel impact at this point in time, the narrative is almost always about there's a big but at the end of that. So they're being justifiably cautious. Silver was down a little bit, 75.16, but there is some tremendously exciting times ahead for precious metals. So gold is down 15% since the war started. When we look at the chart in a minute, you can see we've got key barriers on the downside just below 4,400 and on the upside just short of 4,900. So it's roughly a $500 range that gold is currently stuck in, and it's going to break one way or the other. At this stage, I'm not even thinking about which way that might be, because I would concede that gold could break that 43.80 level, go down perhaps to something like 4,000 before it starts a major run. So don't see a break of 43.80 as being all over for gold. That might just turn out to be a false break. A much more relevant thing to be looking at is this ratio between gold and the S&P. And when gold starts outperforming the S&P, then that will be a pretty significant pivot. So what's really happening here is that the normal safe haven position for gold is just being overridden by the expectations about rate hikes because of inflation, about the preference for US dollars as a safe haven. And I can't explain that. It's beyond me, but nevertheless, that's what markets do. And also about liquidity, because gold is easier to sell than some other assets that might be getting pressured. So if you're scratching your head why gold's doing what it's doing, then that's why. It's not necessarily logical or rational. It just is. If we look at gold stocks, GDX listed on the ASX was down 5% for the week. We've got a situation where the value is there in our gold producers. The massive free cash flows are there. There's no question about that. And the funding to do what pretty much whatever they want is there if they want it. But they don't need it because they're producing such massive free cash flows. But the stocks are out of favour because of concerns, and markets hate unknowns. They hate uncertainty. So that's what's happening. But the setup for once sentiment turns for gold and silver, and it will, is simply amazing. We've got a tremendous period ahead of us, but you've got to be prepared and do the required planning before the event. And in my experience, stocks will start to turn when we least expect them to, because gold goes early. The market's trying to factor in the future, not the current. And so you almost always get surprised when gold stocks start turning up. But the message is that when that evidence is there and it's confirmed, then you want to believe it. Don't second guess it, don't question it, because you've got history on your side. So we'll go to the gold price first of all in US dollars. So this is where we sit. So our range is really from here. So the bottom of this range, which I penciled in when we first got this plunge. So the second week after that plunge happened, other than on an intraday basis on one day, that level hasn't been breached. So between there and probably the top of this current range. So we need to break out above these peaks here. And that's just shy of 4,900. So that's the range there. And a break either way will be telling. If we look at silver, broader range in percentage terms, but the ratio between gold and silver is likely to see silver quite significantly outperforming gold over the next couple of years. It's a very exciting setup. And if we look at GDX, so this is on a weekly chart, you can see the weakness really, or not so much the weakness, but the consolidation, because we'd had an incredible run. GDX had run from 55 and hit a high of 170. So that had to get washed out. And we're still in that process of washing that excess out of the market. All right, turning to other commodities now. Copper was down a little bit, 5.93. Crude oil back up to 102. And the market is pricing, when you look at the futures curves for oil, the market is pricing many months of disruption. So don't expect this volatility to cease anytime soon. There's the spot copper chart, not a lot of movement, and there's the crude oil chart. So it's been extremely volatile between the low 80s and about 113, 114 for West Texas Intermediate. So wrapping it up, the final message, Australia's becoming uncompetitive in multiple arenas, not just in one, but in multiple arenas. And it's going to hurt us in the future. But the key thing for this video is that what does that mean for our stock market? Will our stock market go the same way, where many parts of our economy where we are currently hanging on and we're competitive just become uncompetitive for all the reasons that I've identified in recent weeks, and I think everybody probably inherently knows. So that question, the answer to that question is it's becoming incredibly hard to argue against that, because there's absolutely nothing happening at the government policy level that would suggest that we're doing things to become competitive again on a world stage. And that's very disappointing. It's complacency all round, particularly at all levels of government. So investors, and this is the key point, investors need to plan accordingly. We can't go in there and run the government, but we can certainly control our investments. And despite what you might think, most of the required actions that investors need to take to do well are within our control. Now, okay, we can't change the war, we can't change the oil price, all those things, but we can do a lot of things, and most things are within our control. It's just most investors don't realize it. So you need to toss aside, I covered this, I don't know, probably 4 or 5 weeks ago, toss aside all your perceived market truths, because not only are some of them just not correct, they've just been accepted over the decades. A lot of them aren't correct. But we've now got an incredibly changed environment, and Australia's international competitiveness is going down very, very quickly. So you need to toss aside all the things that you think and that you've heard over the years that you just accept as a given, accept as the market truth, and just start with a clean sheet again. And it's about being very selective and being very clear about what your purpose is. And it's a very simple thought process, difficult for many because you don't know where to start and you don't know what reasonable answers are. But it's really a very, very simple process. And the important thing to recognise about Australia is that there are enough local opportunities in the so-called immune stocks, immune from the energy shock, immune from AI disruption fears, immune from, whatever big picture negatives are out there that we can't control. So just don't buy stocks that are exposed to them. It's pretty simple in my mind. So there are enough immune stocks for any portfolio in Australia. So if you're an Australian-only investor, then don't fret because there's more than enough here to do really, really well, but you've got to plan for it. So that's the message. I guess the other important thing just to complement that is that whilst you don't need to go to the American market to do well, it's a lot easier. There are sectors there that we don't have exposure to. There are sectors there that are doing just so much better than our equivalent sectors here. And there are just so many more opportunities in America. So you can do it in either market. In the American market, it's just a heck of a lot easier because of weight of numbers and opportunities. So that's it for this week. Some more information on the website. There's my email address, and I'll be back with you next Sunday. Cheers.